Good evening, everybody. It's great to be back here in Ottawa. It's, I think, my 10th year coming here now, so hopefully I'm getting used to it a little bit. One of the things which has changed is the video recording, which I'm especially thrilled about because I have 3 teenage sons who go on YouTube and look up at the videos and then make fun of that. So, hi kids. So, as always, thank you for your support and trust in, with your money in managing this portfolio this year. Obviously, markets. First slide, we've just got what's happening in markets. A good year overall in terms of absolute numbers. The MSCI World Index, which is the benchmark of this fund, returned around 8.5%, but there was lots of disparity within the markets that are around the globe. So we had the US market doing particularly well, gaining over 13%, but quite some disparity with some of the non-US markets. UK, Europex UK, pretty weak as well, and emerging markets, very disparate performance among emerging markets, but really led lower by China, which is a significant, almost 30% of the overall benchmark. And one of the reasons for the US outperforming, I think, was obviously the tax cuts that came into force. That resulted in some very good increases in profitability for a number of US companies, and so that kind of helped returns. The other thing which was not a good area to invest last year was in small caps. Most small caps around the world did poorly as well. From a sector basis, again, lots of disparity, but I think if you look at this chart, you'll see the 2 sectors which significantly outperformed, which were utilities and real estate. They're both interest rate sensitive sectors and benefited very much from the Federal Reserve putting rates on hold, and so we saw some strong returns there. And conversely, at the bottom of the list, you've got the financial sector, which for similar reasons does poorly once yield spreads narrow and those interest margins deteriorate. Information technology did well again, but some of the economic sensitive sectors where we've seen slowing growth in the kind of second half of 2018, and that's continued in the first quarter. So you see those energy, materials, industrial stocks not doing so well. Just wanted to remind you of the strategy that we follow. We're very much a value-oriented investment strategy. We're a good company there. Investors like Warren Buffett also follow a value-oriented strategy, and that tends to work out very well over time, but with always there will be bumps in the road. Obviously, we're not as smart as Warren Buffett, because what he does is looks at companies and works out what value they are, and then looks for a discount to that overall intrinsic value of the company. But what we do have is we invest in closed-end funds, and closed-end funds have a daily valuation, which is the net asset value. And in the markets in which they trade, they trade at a price that is different from that net asset value. And so every day we can see what kind of discount each of these funds is trading at. We do think the closed-end funds vehicle is a very good one to invest in. And again, it's like Berkshire Hathaway, which is Warren Buffett's company, in that closed-end funds are fixed pools of assets. And if you ask any investment manager what kind of structure they'd like to manage assets in, they want a fixed pool where they don't have to deal with inflows and outflows going out of the fund. And so these vehicles can be good for generating superior performance. The other thing with closed-end funds is that they do trade at discounts. Those discounts are volatile over time. So you may have, say, a Japan fund, which is at one point in the cycle trading at a 15% discount. That would be very attractive. Another time it may be trading at only a 5% discount, which will be less attractive. So what we try to do is we buy those funds which are trading at wide discounts and then sell out of or avoid those funds which are trading at narrow discounts or at premium. Just to give you an example of the kind of model, hypothetical type situation that we look for, this chart gives a picture of how we try to generate returns. And if you look at the first bar, we've got the MSCI World Index. That's the benchmark of the fund. So each fund, say it's a Japan fund, Japan will have a return which will be either higher or lower than the overall MSCI World return. So that's that country component, which is the second part. So assuming Japan outperforms MSCI World by 2%, that would be additive by 2%. Each of the funds are also actively managed, and so if it's a Japan fund and a Japan manager, they're seeking to outperform that index. And that's that third column, which is the NAV performance, the performance they generate over and above their benchmark. So we seek to get funds that do that. And then the final bar, or the fourth bar, is the discount change. So if we buy it up a 15% discount and it moves to a 10% discount, that provides a 500 basis point return. And so when you add up all of those returns, that's when you get the total return of the fund. And so we're trying to find these types of situations and repeat over and over again. And if you can imagine, if you do that often, you're successful more often than you are, you generate good long-term returns. Now, unfortunately, it doesn't always work out in any 12-month period that you are going to generate outperformance. And in fact, the last 12 months, even though the absolute returns are positive, our relative returns compared to the benchmark were beneath the benchmark. And if you look at the breakdown of the components, which is in the bottom section of this chart, the rolling 1 year and those bottom 4 lines, you can see where the underperformance has been generated. And so 255 basis points of underperformance was generated by our country allocation relative to the benchmark. Currency allocation is effectively a function of country allocation, but that also detracted 23 basis points. And then the NAV performances of the funds that we invested in underperformed their benchmarks by 309 basis points. And then finally, that discount component was positive, and that generated 94 basis points of outperformance. So that's kind of the bread and butter of our strategy is that discount element. Obviously, we try to get our country allocation correct, but sometimes the market differs from our view of where the value is at a given point in time. And likewise, managers will generate outperformance and underperformance through cycles depending on whether their strategy is in our favor. So if we look at the contributors to returns last year, on the positive side, one of the things that we talked about last year was an investment called Pershing Square Holdings. That was a manager who had gone through a significant period of underperformance, but was trading at a very wide discount. Oftentimes, the best time to buy a fund is when a manager has underperformed, and this is what happened this year, that Pershing Square has actually done very well, and that's been additive to returns. Similarly, investments in midstream energy, healthcare sectors have also been beneficial, and also going outside of the benchmark, investing in the China A share market in China, which got very beaten up towards the end of last year with the trade negotiations, That did very well, rebounded in the first quarter, so that has been active. On the detracting side, as I mentioned, it was mainly country allocation, and the biggest bet that we have, or position in the portfolio, is to be underweight US securities relative to the benchmark. And as you saw in the first slide, the US outperformed. Now, we believe that the US market is priced very expensively. We think there's a lot of optimism built into US equity prices, and oftentimes when there is a lot of optimism built into prices, if that optimism doesn't even a little bit occur, then you can see share prices coming off. So we think there's a lot better value elsewhere. Didn't work out this year, but we're still continuing that investment positioning. Likewise, on the NAV performance side, we invested in a number of funds in Japan and Europe, particularly European smaller companies. And as was mentioned, European markets in particular did poorly. Growth in Europe was slowed much more than we and others anticipated, and that has hurt returns in those funds. We still think those managers are good long-term managers, and we think that will come back. So, but in any 12-month period, you can get that underperformance. I didn't mention the good old UK. And we were overweight to the UK. UK is the opposite of the US in some ways, in that there's very little optimism baked into prices or the currency value because of obviously the Brexit process. So, we think that's an opportunity. Obviously, the Brexit process is elongating, but we think that the eventual outcome will be less worse than the market anticipates, and once that uncertainty is removed, some of that value will be recognised. In terms of the global environment, touched on a number of these points, but as was mentioned, the growth environment has been slowing. It's been slowing in the US, it's been slowing in Europe and elsewhere, and a lot of that, particularly in Europe, has to do with the slowdown that we've seen in China. We are now starting to see some stimulus measures being applied, but whereas the US is a relatively closed economy in that a lot of its growth is generated internally as opposed to externally, for Europe it's much more exposed to emerging markets and emerging markets growth, and so when that turns down it gets more affected by that. We've seen, obviously, the bond yields falling a lot, and that part of that has been because of the Federal Reserve taking its foot off the gas, and that's because of economic weakness that is being seen in the data. So we think that a lot of that is somewhat self-reinforcing in that when you have an economic slowdown and then interest rates are not rising, yields come down, that effectively sows the seeds for the next upturn. And so we think, but often with a lag. So we haven't yet seen that coming through in the data, but we think that is a second half of the year likely phenomenon. As I mentioned, one of the keys is the China-US trade discussions. I think thinking about this from a political perspective, President Trump is going to be looking to get re-elected in 2020, and one of the things that I think he would like to be able to claim is that he has achieved a trade deal, a great trade deal, I'm sure, and to be able to sell that to the US public. Now, if he gets a deal too quickly, then the effects of the trade deal may come through in the data. So from his point of view, he wants to time it, I would think, to get a deal, be able to claim it's great, but not be able to see actually whether the results are that it is great. So I definitely think there will be a resolution to it, and you know, that will obviously remove one of the key risks in the market. One of the things that has also been happening from a US perspective is that profitability has been slowing a little bit because you effectively had profitability goosed by the tax bill, and so profits went up sharply last year, and then just from a comparative purpose, they're now not going up as quickly. The level is still rising, but the market has also risen, and so valuations have got a little bit more expensive. So, you know, overall, we think valuations outside the US are much more attractive. We think if there is a growth revival in the second half of this year, those non-US markets and economies are likely to do much better in that type of environment, and also the dollar is likely to weaken against those other currencies as well in that environment. So we think it will be a good environment for investing outside of the US, and also emerging markets also offer attractive valuations. As far as the Brexit outcome, as I said, no one really knows exactly what's going to happen there. But I think what the delay that they've just announced shows is that no one wants a no deal. So whatever they come up with, be it another referendum or some kind of a Brexit, it's likely to be a much softer Brexit than the worst case scenario, which would be leaving without any kind of deal. In terms of positioning, I've pretty much covered this. You know, we're overweight US underweight US and overweight elsewhere. From a sector point of view, we're also underweight the IT and communication services sectors, and that is really somewhat a function of being underweight the US because a lot of those companies are listed there. But we also think that the valuations in those companies are quite stretched. Our overweights are to cyclical sectors, energy, industrials, materials, and also to the financial sector that has been fairly poor. So just to summarize, you know, a very much value-oriented approach, you know, using that kind of Warren Buffett style, utilize closed-end funds, which we think are great vehicles for active management. We exploit the valuation efficiencies of those discrepancies of those closed-end funds. And also, this portfolio, by virtue of investing in a number of closed-end funds, is very diversified. So there's very low individual stock-specific risk within this portfolio. And what that means is it's also very complementary to if you invest in the Tradex equity fund, which is more of a stock-picking fund. This will be very complementary to that type of investment. And then finally, we've just got our unders and overweights there. I think I've been through them, but within the emerging markets, we do have positions in Mexico, which has also been sold off heavily after the Trump election, and also the China A share market.